Right now, as the market is live and trading, Pfizer, ticker PFE, is at $24.97. That's a pop of 1.71% or about 42 cents on the day. And while any green on the screen is a welcome sight for long-suffering holders, this move isn't what you think it is. This isn't the market suddenly falling back in love with Pfizer. This move is a direct reaction to the company's third-quarter earnings, which just hit the wire. And the reality of this company is far more complex and, frankly, more desperate than most investors realize. The common belief, the one that probably has this stock sitting in your Fidelity or a SoFi Invest account, is that Pfizer is a safe, high-yield dividend play. It's the hero of the pandemic, the maker of Comirnaty and Paxlovid, now settling back into its role as a stately, if boring, pharmaceutical giant. You buy it, you set up the dividend reinvestment, and you let your Schwab Intelligent Portfolio's algorithm manage it. The expectation is stability and income. But the reality? The reality is that Pfizer is a company in a street fight for its future, battling a massive two-front revenue war. And today's earnings report just gave us the playbook. Yes, they beat expectations on profit, reporting an adjusted 87 cents per share when Wall Street was only looking for around 63 or 64 cents. That's a big beat. But how they got that beat is the entire story. It wasn't from a surge in sales. In fact, revenue came in at $16.65 billion, basically exactly in line with what was expected. The beat came from one place: cost-cutting. Deep, aggressive cost-cutting. Pfizer is on track to pull $7.2 billion in net cost savings out of its operations by the end of 2027. So that pop you see today? That's the market applauding financial discipline. It's rewarding the company for tightening its belt, not for finding its next great blockbuster. This isn't a growth story. It's a survival story dressed up in a profit-beat costume. Let's look at the pressures. This stock isn't trading near its 52-week low of around $21 just for fun. It's down because of the COVID cliff. The billions upon billions in revenue from the vaccine and Paxlovid are evaporating and fast. That's one front of the war. The second, and arguably more dangerous front, is the upcoming patent cliff. Between 2026 and 2030, Pfizer is staring down the loss of exclusivity on drugs that account for an estimated $17 billion in revenue. This is a staggering revenue hole to fill. This is why comparing Pfizer to something like Nvidia stock or Tesla stock is a category error. Those companies are priced on exponential growth expectations. Pfizer is priced on whether it can simply replace the massive guaranteed income it's about to lose. This is why so many retail traders on platforms like Robinhood have been burned, buying the dip all the way down, thinking it was cheap, without understanding the fundamental storm the company is sailing into. So, what is the plan? It's not just cutting costs. The other, much bigger part of the plan is the $43 billion acquisition of Seagen, which closed at the end of 2023. This was an all-in bet. Pfizer didn't just buy a company. They bought an entire world-class oncology platform. The goal is to transform Pfizer into an undisputed leader in cancer treatment, hoping that Seagen's pipeline of antibody-drug conjugates, or ADCs, can grow fast enough to fill that $17 billion patent gap and the COVID gap. Today's earnings report gave us the first real glimpse of that. The company's non-COVID portfolio is actually showing decent strength, with 4% operational growth. Products like the anticoagulant Eliquis are up 22%, and Nurtec for migraines is also up 22%. The Seagen-derived oncology drugs are now part of this mix, and the market is desperately looking for signs that this massive investment is paying off. The analyst community remains skeptical. The consensus rating on Pfizer is a hold. You don't see many buys because the risk is so visible. They see the high dividend yield, which is now approaching a massive 7%, not as a sign of strength, but as a signal of distress. A payout ratio that has crept up toward 90% is a warning sign. It tells you that the company is paying out almost all of its earnings to shareholders, leaving very little room for error, reinvestment, or further downturns. Many are using their Fidelity investments accounts to hold this, but they're watching that dividend safety like a hawk. And just when you thought the story couldn't get more intense, a new battle has just erupted in the last few days. Pfizer is trying to get into the single most lucrative market in pharma right now, obesity drugs. They failed spectacularly with their last candidate, danuglipron, due to side effects. So they set their sights on a smaller developer, Metsera, agreeing to buy them for around $7.3 billion. But then just days ago, the 800-pound gorilla of the weight loss world, Novo Nordisk, the maker of Ozempic and Wegovy, swept in with a surprise $9 billion hostile bid to snatch Metsera away. Pfizer is now in a public war of words, calling Novo's move reckless and anti-competitive and vowing to fight it. This is high-stakes corporate drama. Pfizer needs a new growth engine, and the obesity market is it. Losing this battle to the very competitor that dominates the space would be a devastating psychological and strategic blow. This is the kind of fight that sophisticated traders on Interactive Brokers are building complex option strategies around, betting on the acquisition outcome, the legal fights, and the subsequent stock volatility. So let's put this all together. When you look at your Fidelity mobile app or your Robinhood app and see PFE up 1.7% today, you have to understand the tension between expectation and reality. The expectation is that you own a safe, boring dividend stock. The reality is that you own a legacy giant in the middle of a painful multi-year transformation. It is simultaneously slashing its internal costs to the bone to please Wall Street's quarterly EPS demands, while also spending tens of billions of dollars on massive acquisitions, Seagen, and fighting off competitors in bidding wars, Metsera, just to have a chance at future growth. The non-COVID business is healthy, but it's not a silver bullet. The Seagen acquisition must work. There is no plan B. This is why the stock has been crushed, and why today's beat is met with cautious, skeptical buying. The market is rewarding the cost-cutting, but it's not yet convinced the growth strategy will work. This brings us to the future outlook. There are two very clear paths for Pfizer from here. In the bull case, the $7.2 billion cost-cutting plan works, permanently improving margins. The Seagen oncology pipeline delivers multiple blockbusters, and its growth, combined with the strength of Eliquis and the rest of the core portfolio, successfully bridges the gap from the patent and COVID cliffs. Maybe they even win the Metsera battle or find another way into the obesity market. If all of this happens, the stock at $25 is an incredible bargain, and the 7% dividend was a gift. The bear case, however, is just as likely. In this scenario, the cost cuts are just a temporary fix. The Seagen integration proves too slow, and its pipeline isn't enough to fill that $17 billion hole. They lose the obesity battle. The cash flow from the declining COVID franchise dries up, and the pressure from the patent cliff becomes too much. In this world, the company is forced to make a choice, and the first thing to go will be that giant dividend. If they cut the dividend, the last pillar holding up the stock is gone, and the value trap snaps shut. This is what's at stake. This is the real story behind today's 1.7% gain. Here's a question for everyone watching. Comment below with your thoughts on this. Is Pfizer's $43 billion bet on Seagen enough to save it from the patent cliff, or are they just treading water? I want to know what you think. In the end, Pfizer's stock is the perfect case study in expectation versus reality. The market expected a simple post-pandemic decline into quiet dividend-paying utility, The reality is a company executing a high-wire act with no safety net. Today, they showed they can control their costs, and the market gave them a small nod of approval. But the real test, the integration of Seagen and the desperate search for new growth, has only just begun. What we're seeing isn't a recovery, it's the opening move in a much, much longer game. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.